Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Goldman raises its target for US stocks after the interim US-China trade deal sparks a global equities relief rally. The US president heads to the Middle East for his first overseas visit of his second term in the White House. Donald Trump says he may attend negotiations between Ukraine and Russia later this week in Turkey. Plus, we'll hear exclusively from UK Chancellor Rachel Reeves after pension fund managers agree to boost UK private market investments.
In the meantime, a quick check on the markets. Going into the open, we're about an hour out at the moment. Eurostoxx 50 futures virtually unchanged. We see U.S. futures taking a bit of a breather, coming off of that green on screen you saw in yesterday's session. Only natural to take, I see a little bit of reprieve. The 10-year yield is interesting. We are very close to that 4.5% level. That is part of the risk rally. We'll see if it stays there. 4.45 on the 10-year yield over in the States. But matched perhaps by a weaker dollar this morning. Again, pulling back on some of the gains from yesterday. The Japanese yen strengthening. Keep an eye on what's going on in those Japanese assets. The countdown to the opening trade starts right now.
There are no winners in tariff wars or trade wars. Bullying or hegemonism only leads to self-isolation.
The talks in Geneva were very friendly. The relationship is very good. We're not looking to hurt China. China was being hurt very badly. They were closing up factories. They were having a lot of unrest. And they were very happy to be able to do something with us. And the relationship is very, very good. I'll speak to President Xi maybe at the end of the week.
Trump cracks, stocks soar. The taco trade delivers once again. Big day yesterday for markets. Futures are a little softer this morning, but Trump always chickens out. That seems to be the trade that works right now, and it delivered big time yesterday.
Another way of saying that might be buying the dips, because that's what we heard from Max Kettner. I noticed he was quoted in one of our stories this morning. But things don't move in a straight line, do they, Guy? And yes, it was a big day for risk on yesterday. Pretty much every asset class was risk on. Today we see something more nuanced, don't we? As you point out, US futures are a little muted, but obviously not unwinding what we saw in yesterday's trade, but maybe just drawing a line in the sand for the moment and seeing where we go. Because there are still big questions that hang over this interim trade arrangement agreement that's been made between these two countries. President Trump himself saying that China is going to remove all non-tariff barriers, promised to really open up China. According to our reporting, what China is pledging is to remove some of the barriers on the exports of rare earths that were imposed since April 2nd. So that's quite limited. That's quite small in scope. That's not opening up China to foreign ownership of everything. So I wonder if we're all on the same page on what this really means.
We're not on the same page. There's no way we're on the same page. There are no details.
There are many pages.
There are many pages, and they are blank at the moment. That is the problem at the moment. And everybody's on slightly different pages. You do have some good news coming out for Boeing this morning. Kelly Ortberg, the CEO, is waking up. I suspect, I think he probably is in Seattle, but he may be somewhere else. But wherever he's waking up, he's getting some good news. He can start delivering aeroplanes to China once again. It's a huge market. That needs to happen. I suspect he could have sold a lot of 737s to other people, but nevertheless, that's a good thing. That is a tangible thing that has come out of this, which is fairly quantifiable and fairly easy to deal with. But yeah, yesterday was a relief rally. Yesterday was a covering rally. But it does seem once again as if the extremes are being priced out. We laugh about the taco trade, but people genuinely are talking about this.
I'm sorry, what?
Trump always chickens out.
Oh, okay.
Is the trade.
Sorry, for a second I was like, where is...
It should be Taco Tuesday, but it was yesterday Taco Monday.
I didn't understand it. Okay. Thank you for clarifying for me and the global audience about the taco trade. I think it's fascinating, to your point, of how quickly the strategists have come back and taken a complete U-turn. You mentioned Goldman Sachs in the headlines there. 6,500 in the next 12 months. The recession calls that were plaguing Wall Street in the last 30 days, frankly, have completely disappeared in 24 hours' time.
It's all quite tactical, though, isn't it? It's quite tactical. I mean, I was going to say short-term, end of the year is not short-term, but it's quite tactical in terms of how you trade those stocks. It doesn't necessarily, to your point, mean a big fundamental rethink about what is happening in global trade, because even as Scott Bessent and President Trump, to some degree, are saying, look, it's not about picking on China, it's not about decoupling even, is what Bessent was saying yesterday. But I've read plenty of strategist notes that have said, well, that might not be what they think is happening, but the market is assuming that is happening, and the market is moving in the direction of that, at least moving along that continuum.
And what happens with Europe? if he's gone soft on China, does he have to go hard on you? There's so many kind of permutations here that I still think we've worked out. I think one thing we probably shouldn't assume is that the volatility is over.
Yeah.
Okay, so we're now kind of pricing in a base case. Oh, stocks are going to go from here. They're going to rally. I suspect there's going to be some shifts and changes along the way.
Absolutely. And you mentioned the EU. Let's go to another region that we've got our eye on as well, and that, of course, is the Middle East. Donald Trump, I believe, due to arrive there shortly, and we are, of course, getting some live images from some of the panels that are coming from there right now. I believe the opening remarks of the Saudi-U.S. Investment Forum currently happening by Saudi Arabian Investment Minister Khalid Al-Falih. This is really important because not only is this attracting, of course, geopolitical leaders from the United States and from the Middle East, but several corporate leaders as well. And this is where the Saudi story is really important here. They're trying to attract more foreign direct investment, not just from the United States, but globally. Of course, the U.S. a key part of that. So the fact that corporate CEOs are there and financiers are there from Wall Street is quite telling.
And you wonder how much two sectors are going to hang over this. On the one hand, oil. On the other hand, AI and technology. So on the one hand, oil, because the oil price has been a lot weaker, apart from yesterday. It's been a lot weaker. And that, of course, makes it more difficult for Saudi Arabia to pivot its economy away from oil into other things. It messes with its budget, for example. President Trump has been wanting those lower oil prices. There's a lot to talk about there. But AI seems to be a feature of this Saudi dialogue, and that seems to be where they want to spend their time talking. So we'll see whether that's a theme that's sort of picked up
hard for oil prices to go higher in an environment where Trump is in the Middle East will be maybe the take. He doesn't particularly want higher oil prices. He's actually had lower prices. It's going to be interesting to see what the CPI data looks like a little bit later on today. It's going to be interesting to see kind of what effect this is having. In some ways, this may make it easier for US consumers to actually battle their way through what is happening with the uncertainty elsewhere. At least gas prices are a little bit down.
For the consumer, a good chunk of Trump's base is from the South, where their economy and their livelihood is based on oil exports from the United States. And I think this is where OPEC is trying to kind of play the long game here in terms of increasing their output despite suppressed oil prices to reclaim some of that market share from the United States. And that's going to be something, as you say, looms over, very much looms over this summit.
Shall we pivot to the UK? We've got data coming
I'm not sure how you do that, but let's talk about... So you've got UK data. We'll come to that in just a second, which is broken in the last couple of minutes. We've also had retail sales overnight, which tell you two things. One of which, Easter was late. Great, we knew that. We can see a calendar many, many months ahead.
Are you going to say something about the sun?
I may say something about the weather, and apparently it was quite good, and as a result of which people are going out shopping. I'm not sure there's a longer-term story in all of this, in what is happening with the UK consumer scene at the moment. In fact, I think probably the UK consumer, and this takes me to the next piece of data, is actually under a little bit of pressure. The data this morning comes through the January to March wages excluding bonuses rising 5.6%. Now, that's still quite a toppy number, but it's slightly softer than anticipated. It's still quite a decent number, and that is something that the Bank of England will pay attention to. The unemployment rate is basically broadly stable as far as I can tell. There doesn't seem to be any significant change in what is happening here. We've obviously seen the impact of the tax rises coming through. And actually, the immigration story yesterday, I think, was quite germane to this story too, in as much as I think employers are going to be worried that there is going to be a restriction on the ability to bring labour into the UK going forward from here as a result of these changes. So in some ways, the labour market in the UK is being affected by all of what is happening with UK government policy at the moment. And there's quite an easy and obvious read-through into some of it. But this morning's data basically just tells you people are out shopping, their wages are up, maybe not as strongly as they were, but the broader picture is OK.
And it's that not as strong as they were expected to be wages story that has Bloomberg Economics going into this number, at least saying that that's what is going to allow the Bank of England to cut rates at a quarterly pace. That's their expectation. We will be speaking to the UK Chancellor, Rachel Reeves, exclusively here at Bloomberg TV. Stay with us for that. That takes place right after the market open today.
Mansion House coming up, so we will have that conversation. Lizzie Burden's going to be having that conversation very shortly. Simon Dagnon is going to be joining us from Goldman Sachs. Asset management, fixed income macro strategist. A busy day. I suspect he's got a lot to talk about. Sonia Martin, DZ Bank, is going to be joining us. FX and monetary policy research head. Louise Dudley, Federated Hermes portfolio manager. And Sarah Ketterer, Causeway Capital Management, joining us a little bit later on as well. I've read her notes this morning. I think the taco trade is something that she may talk about as well.
I'm glad we all know what it is then.
Yes,
conversation.
I'm still reeling from the fact that we're using tacos as an acronym. It might take me the rest of the show to get through it. Let's talk about what else we've got throughout the rest of the day as well. Of course, I think the main highlight when it comes to U.S. politics is going to be Donald Trump in Saudi Arabia. Let's see what lines we get out of that summit, and not just from Donald Trump, but of course some of the other corporate leaders that are there as well. Some data hitting the wire as well. As Guy mentioned, the big number is going to be that CPI print, although might not even be relevant today. We have small business optimism, and then, of course, we have the ZE or the ZEW survey over here in Europe as well. But again, bringing it back to some of the U.S. data.
Right, yeah, the US data certainly will be in focus. I was looking just briefly at the ZEW, and the expectations number there is really expected to tick up. So from -14 up to +11. So we'll see what, obviously a lot of this depends on when exactly the survey window was and where we were in the trade narrative at the time that they pressed
But Germany's at the epicentre of the good news story, isn't it?
It is.
It's got the fiscal story. We don't know yet what is going to be happening with the EU-US trade narrative, but if you extrapolate from the China narrative, maybe you can think good things. I don't know. Maybe that's what we're going to see in the ZEW survey a little bit later on. What else do you need to know this Tuesday morning? US House Republicans have unveiled details of their long-awaited tax package. The draft bill includes many of President Trump's campaign pledges, including no taxes on tips and overtime pay. It also makes permanent the lower individual tax rates legislated in 2017. However, it does not include a tax hike on the wealthiest Americans, something Trump has pushed for as recently as last week. Global drug makers are breathing a sigh of relief this morning as President Trump's executive order aimed at cutting US prescription drugs failed to deliver the worst-case scenario. The president's plan to cut costs asked the industry to lower prices voluntarily. US drug makers closed higher yesterday in the US session. And Donald Trump has raised the possibility of flying to Turkey this week to join potential talks over the war in Ukraine, or an end to that war. These talks are potentially going to be between Volodymyr Zelenskiy and Vladimir Putin. It's the latter that we're asking questions about. Following a weekend of hectic diplomacy, I can't speak this morning, sorry. Zelenskiy has said that he will travel to Istanbul on Thursday, where Putin has proposed direct negotiations. The Kremlin hasn't said yet whether the Russian president will attend himself. Quite a pivotal moment. If you were to see Zelenskiy, Putin and Trump all in the same room together, do we think a deal comes out of that?
Next to Erdogan as well, who's been such a key diplomat in terms of not just the ceasefire, but also the grain exports that are going to be coming or potentially have been coming out from that region. If we're talking about an inflation read-through, this summit is pivotal.
And I suppose if President Trump is in the room, does that add the necessary dynamic to push this over the line? And that we don't know, do we? He's just sort of mused on it so far.
I can't believe that if all three were there in the same place, that there wouldn't be a deal. You couldn't walk away from that if you're President Trump without a deal.
In an old-school, diplomats set it up and then the big names arrive last minute to push it over the line kind of scenario. Absolutely. I just wonder if we're in a different space right now where these things aren't all lined up for the leaders to just arrive and sign on the dotted line. But, yeah, who knows?
There have been former US summits with Russians where Russian leaders have walked out.
Yeah.
So obviously history is replete with lots of examples of that happening. Obviously, I'm trying to think of the example. I think it was Khrushchev walking out on Eisenhower. I can't remember. I think it was something to do with the U-2. But that is the kind of historical precedent we're looking at here. But you're right. History would dictate that normally you put everybody in the same room, you would get a deal. So if Putin shows up and Trump shows up, you've got to assume that something's going to happen.
Meanwhile, and Europe won't be at that table. Ukraine, at least, will be at the table. But Europe has said that they will wait until...
He can't sit there on his own, can he?
No, but Europe's going to wait until at least Thursday to see what comes out of this before deciding on any further sanctions.
Well, it's so funny. Over the weekend, all eyes were on Geneva from the U.S. and China picture. But there was a picture that circulated of Keir Starmer, Emmanuel Macron, Donald Tusk, and Friedrich Merz as well, all kind of huddled around a phone that I assume had Donald Trump on the other line. So for none of them to be in that room is telling.
OK, coming up on the programme, the Spanish government is reportedly open to a tie-up between Banco Sabadell and another domestic bank to counter the unsolicited bid for BBVA. We will get to that in our Stocks to Watch segment later on. Plus, President Trump is expected to land in Saudi Arabia later this morning for his first scheduled trip abroad since returning to power. Up next, markets breathe a sigh of relief. We will discuss the market optimism around the US-China trade truce. How long-lived is it? Did we see it all yesterday? Does today look a little different. Simon Dangle from Goldman Sachs Asset Management and Sonia Martin from DZ Bank will be joining us to talk about those themes. If you have any questions, if you want to get involved, have your voice heard in these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
We are getting live pictures from the Saudi U.S. Investment Forum currently underway in Riyadh at the moment. On stage, the U.S. Treasury Secretary and Saudi Arabian Finance Minister. Let's take a few minutes to listen in to what they have to say.
And success. It sounds like you have made huge progress in the relationship, and the next 90 days are going to prove to be critical. Can you share a little bit more about the deal, how the talks went, and what you think will happen in the next 90 days?
Good. Well, thank you, Dina, Excellency. First of all, I'm going to say it's wonderful to be here. I have a long history with the kingdom. The governor of South Carolina, where I'm from, John West, was the ambassador to the kingdom under President Jimmy Carter. He was a close family friend, so I grew up hearing stories about the kingdom as a child. And then my first proper job in New York City was working for the Olayan Group. I have a long history with Saudi. And before we go on, too, I do want to have a hat tip to our moderator here. Dina Powell is the personification of the perfect internal and external public and private person in the United States.
Thank you.
Her family moved from the Middle East to Texas. She attended the University of Texas. She's had a major role in the first Trump administration, and now, for now, she's on the outside. So,
thank you. I'm honored. Thank you, Mr. Secretary. I really appreciate that. Thank you. Thank you so much.
And yes, so we had a very active dialogue in Geneva this weekend. It was very constructive. Both sides came with a clear agenda, but shared interest. We had great mutual respect. And I think what we were able to establish as President Trump and the administration began the tariff program, we had a plan, we had a process, and what we did not have with the Chinese was a mechanism. So the Vice Premier and I now call this the Geneva mechanism to prevent any misunderstandings, because President Trump and Party Chairman Xi have a very good relationship, but the relationship did not make its way down through other levels of government. So I think the important thing is that after this weekend, we have a mechanism to avoid escalation like we had before. We both agreed to bring the tariffs levels down 115%, which I think is very productive, because where we were with 145 and 125 was the equivalent of an unintended embargo. That is not healthy for the two largest economies in the world. It is not healthy for the rest of the world. So I think we can proceed from here. We have a very good framework, and as I said during IMF week in Washington about 3 or 4 weeks ago, there is a possibility, it's not a certainty, but that, as Ray Dalio might say, we could do a big, beautiful rebalancing. President Trump wants to rebalance the American economy back to a manufacturing economy with high precision manufacturing. I think everyone agrees, including Chinese leadership, that they need to rebalance towards more of a consumption and consumer economy. And the dream scenario would be if somehow we could do that together.
And what do you think the next 90 days look like? It sounds like very productive meetings and now people talking to each other, as you say. Were there areas that you kind of put to the side or, really put everything on the table?
I think everything is on the table. We have a very good framework from President Trump's first administration. There was a treaty that was signed, a trade treaty, a trade agreement that was signed in January 2020. So we're not starting from ground zero. We have a framework, and we can go from there. Obviously, many things have changed over the past 5 years. And look, what we don't want, and both sides agreed, we do not want a generalized decoupling between the two largest economies in the world. What we want is the U.S. is going to decouple in strategic industries, which we saw during COVID. We had become woefully non-self-sufficient. So whether it's medicines, semiconductors, other strategic areas. So the United States will bring those industries home. But the idea isn't a generalized decoupling. And we do have a very large trade deficit with China. That could be solved in many ways. And my hope it is via Chinese buying more American goods and the U.S. selling a kind of opening up of the Chinese consumer, and then that will lead to more fair and balanced trade.
One last question on trade. President Trump has tasked you and Ambassador Greer and Secretary Lutnick to look at other countries and hopefully have other deals like you did with the UK. Do you feel good about several of those also coming through in the next period of time?
Yes, so I've been focused on the Asia deals, of which obviously China is the largest. We've had very productive discussions with Japan. South Korea is going through a governmental change, but before they went into the election cycle, the South Koreans came with very good proposals. Indonesia, who's a large trading partner, has been very forthcoming. The island of Taiwan has presented very good proposal. Thailand, so things on my side of the world, things are going very well. I think the U.S. and Europe may be a bit slower. My personal belief is Europe may have a collective action problem, that the Italians want something that's different than the French. But I'm sure at the end of the day, we will reach a satisfactory conclusion.
Great, thank you. So, Your Excellency, we were talking backstage about 2017, when really not many people in the world had heard about Vision 2030. And in 8 pretty short years, it's really remarkable to see all that the kingdom has done in social, economic, and political reform. You have been a key leader in diversifying the Saudi economy, in bringing investment.
Okay, you've been listening to a conversation coming out of Riyadh. Obviously, we've just been listening to the US Treasury Secretary Scott Bessent, who has hot-footed it to Riyadh from Geneva. In terms of the headlines, we've now got a Geneva mechanism. That's what he's talking about. This is the mechanism that will now prevent further escalation in terms of the story coming through with China. Talking about Europe, though, interesting collective action problem. Europe doesn't know who speaks for it. That is something that's going to be very relevant in Brussels, I suspect, this morning. Feels like Europe is further down the food chain in terms of the priorities that the United States now have. Bessent says he's focused on Asia. Europe feels like a long way down the story. Anyway, a beautiful, big rebalancing is what apparently President Trump and Scott Bessent are now looking for. We will have analysis in just a moment. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes until we start equities trading, cash equities trading here in Europe. The futures picture, though, looks like this. For Europe, the picture is a little mixed, a little uninspiring, perhaps, after yesterday's excitement. But certainly risk assets were bid yesterday. We saw stocks going higher. We saw yields going higher as we were pricing out some of those rate cuts around the world, certainly in Europe and over in the United States. Let's have a look at bond markets with that in mind, because today looks a little different on both fronts. We've got US stock futures a little on the back foot. We've got yields coming down just a touch versus yesterday. So yesterday was exciting. We'll see what today has in store, Guy.
A little calming down would be quite nice, actually, to be honest. But we've already seen, obviously, the Treasury Secretary speaking over the last few minutes, just kind of reinforcing some of the points that we were talking about yesterday. Let's get some analysis. Simon Dangor, Head of Fixed Income Macro Strategies at Goldman Sachs Asset Management, joining us around the table. And Sonia Martin, Head of FX and Monetary Policy Research at DZ Bank, joining us from Germany. Good morning to you both. Simon, let me start with you because you're sitting next to me. What changed yesterday? What has changed over the last few hours? And does this change feel permanent to you? Is this are we now in a new paradigm versus the paradigm we were in on Friday? How much has changed since then?
Hey, morning. Thanks very much for having me. I think some material things have changed. As Scott Bessent was talking about, we have a mechanism. The route to de-escalation before that wasn't very clear. And also the tariffs with China have transformed from looking like something which was an embargo to something which looks more digestible from the perspective of the supply chains. I think when you sort of looked at the outlook that we were facing, there were real concerns around supply chain disruptions in the next couple of months. That seems to be much more off the table now. And so whilst I think we could certainly see some slowdown of growth, anyone plugged into the trading system is still facing a lot of uncertainty. Yep. Those worse, more acute, maybe recessionary scenarios look much lower probability here, and therefore it's unsurprising that risk appetite has come back a reasonable amount. Yeah, some of the big tail risks maybe have been taken out of the market. Sonia, what do you think? What's changed in the last few hours for you?
Well, obviously, we have seen, as Sam just said, a massive change of sentiment in the sense that, we now have some hope that the worst may be behind us. The problem is, of course, it's difficult to judge why Donald Trump changed his mind. Did someone explain it to him? Did he finally understand that tariffs hurt the U.S. just as much or even more than they do other countries? If that's the case and he finally understood those mechanisms, then we have maybe a reasonable hope that, things will not deteriorate significantly again from here. But you can tell by the market reaction as well, there is, of course, continued uncertainty. He is very unpredictable. He might get out of bed on the wrong foot one day and decide to change his mind again. So I think that's what the market is trying to figure out right now. It'll probably take a little time to sort of gauge more accurately where the road is going to go from here onwards.
Sonia, so we've seen a recovery in the equity market, to some extent the bond market, in terms of the volatility, as you mentioned. We haven't seen a recovery. I'll even throw in oil in there because we've seen a recovery there as well and a retracement of some of the other commodities. What we haven't seen is a solid recovery in the dollar yet. What would it take to restore the confidence that a lot of international investors had in the dollar?
Well, I mean, the dollar index has risen. When you look at Eurodollar in particular, I mean, we have seen, I would say, a fairly sized move on the back of these developments. So there is some recovery. I think for a more significant appreciation of the dollar, I think we would need to see more evidence over a longer period of time that Trump is planning to stick to a more cautious course of action when it comes to tariffs. And that may give the dollar a bit more of a lift. Having said that, I do believe that some of the damage here has already been done. We are talking about a potential quite significant loss of confidence in the US dollar. And I think we can't take that back just by one action that happened over the weekend. It'll take more than that, I think, to restore that. And the thing is, even though Trump has now backpedaled on the tariff side, there are still so many other things at play in the US here that I think it will be difficult for the dollar to go back, to the strength that it was before.
So, Simon, come on in here then. We're talking about a loss in the confidence of the dollar. We haven't yet seen a real loss, at scale at least, in terms of confidence when it comes to the U.S. Treasury story. We had Kit Jukes on from SocGen yesterday around the table saying that the biggest risk in the FX space is simply that $62 trillion worth of kind of this haven quality is buried in the dollar, and that's the risk itself. Does that logic apply to the Treasury market?
Well, I think Treasury markets and, in fact, long ends of the curves pretty much everywhere are just struggling by just how large fiscal deficits are everywhere. And you're constantly having to find more and more buyers to come in to support, particularly at the back end of the curve. When you look at term premium, we're still at reasonably moderate levels compared to where we've traded in the past. So against all of the uncertainty that Sonia was talking about, it's perhaps unsurprising that we're seeing the market sort of push to try and find where the more dependable clearing level is on long ends of yields. In terms of the sort of bigger picture around US assets, I think we've got to be careful not to throw the baby out with the bathwater. This particular series of shocks that we've had have been something which have raised some questions about the US, but from a starting point where investors were perhaps almost too optimistic about the relative positioning of the US. But the US is still much more resilient to many types of shocks that we could face over the course of the next couple of years. And as we keep on finding out, we're in a very shock-prone world.
Yes, we do seem to be. Yes, that's a nice way of putting it. Let me ask you then, Simon, about the decoupling narrative and how far you think that goes. We heard this from Scott Bessent yesterday saying China and the US does not want to decouple. We heard it from him just moments ago again this morning. That's not the end goal. The US does want to decouple on some strategic industries, but more broadly, we don't want to decouple. What do you think investors should take away from that in terms of how much all of these moves towards decoupling, away from decoupling, really matter? What do we see as the end goal?
Well, I think it is helpful that we're starting to get a little bit more strategic clarity about what the administration in the US is trying to solve for. As Sonia mentioned as well, though, I think we still have to be a little humble about exactly how this is going to play out. I think it's clear that some of the most extreme scenarios are out, and something which is more about the strategic alignment of key industries is in, and that's encouraging. But I would still say that anyone who's faced with being plugged into the trading system still really can't plan in the way they might have thought they would have been able to plan 6 months or so. And so perhaps it's inevitable that we're going to see some slowing of activity as we go through the next few months. You know, when you're sort of faced with uncertainty as we are now, then diversification is your best antidote. So, in fact, as the market sort of backed up bond yields here, we actually think it makes sense to add some duration into portfolios to ballast any risk asset positions. And that now, with only perhaps about 4 cuts for the Fed by the sort of middle of next year, towards the back end of the year priced, there's a reasonable number of scenarios where you could deliver a path of rates lower than that.
OK, and where does that leave the euro then, Sonia? Because a lot of the focus, I mean, we're up at 115, now down at 111 on euro dollar. Does it continue to weaken from here, or have we stabilised once again?
Well, I think the correction was obviously overdue, and not just from the US side of the equation, but I think also from the European side. I mean, earlier this year, a lot of optimism was priced in when the German government revealed its plans for large fiscal spending. And obviously, we now see that this is going to play out in a somewhat slower way than maybe people had hoped for. It's going to be a long and thorny journey, I think, until that money actually gets invested and generates some growth. So I think the correction was overdue. I'm not necessarily pessimistic on the euro. I do think we have better prospects for growth in Germany in the longer run with this package on the way. So I actually think euro dollar around 110 is probably quite a happy place for it to be. But I think we're going to have to continue to expect to see some significant volatility in this market, just because there is a lot of news flow both from the European side as well as from the US side that's going to, change direction as we go along. So I think 110 with a very wide range around is probably the best place to be right now.
Yeah, you could fold in Ukraine. That could be one factor in this mix as well. Plus, what happens with the trade deals between Brussels and Washington? Is it Brussels and Washington? Is it Rome and Washington? I don't know who's ultimately negotiating for the EU. Simon, can I just come and ask you a question, which is a slightly counterintuitive one, which is kind of floating around at the moment. Does the trade deal with the United States make rate cuts in the United States more likely, not less likely? And the reason for this is that you take out the tariff inflation hit, and actually you've got a Fed that doesn't need to worry about inflation as much, so therefore can focus more on the growth risk to the downside, and as a result of which, therefore, maybe will be more likely, not less likely, to cut rates. Does that hold water? Because I'm hearing it floating around as an argument.
I think there's a timing question in that. Ultimately, what's going to drive the Fed in terms of whether they cut more or less is going to be what happens to the labour market. In the final analysis, this will be a very labour market-sensitive Fed. Of course, the degree of tariff-related inflation that we're going through is going to drive their timing around that, how early and how proactive they can be about that decision. So perhaps sort of less intense tariff inflation today allows them to be a little bit more proactive than they otherwise would be. But ultimately, it comes down to where the labour market is going to go.
Sonia, come in here. What do you think to that? I mean, you just heard Guy pose that question of what a trade deal means for the Federal Reserve's rate agenda. Your thoughts?
Well, I fully agree with Simon. It's an incredibly difficult timing decision for the Fed. The fact that we get less tariffs, at least hopefully that's going to remain the case, means less inflation. But the labor market is key, and we have some very strict immigration policies that are being implemented in the US, and that's going to impact the labor market as well. And on the other side as well, if we have less tariffs, that means prices will be lower, and that also means that consumption might be higher. We might actually get a bit better growth, and those Trump session fears that we have been playing these last few months, weeks, might be declining. So that, so all of this in the mix makes it very difficult. And I think the Fed is well advised to remain very cautious and move from meeting to meeting as events unfold. And when we look at the longer term picture, let's not forget that in a year's time we'll get a new Fed president as well, and that's going to be an interesting shift in dynamics for the Fed too. So they will be cutting rates more, obviously, and I think the timing will absolutely depend on what comes out of Washington.
Sonia Martin joining us from DZ Bank. We thank you so much, as well as Simon Dangor joining us over at Goldman Sachs around the table. We thank you so much. Anna.
Yeah, thanks to both of you for your thoughts this morning. Now, the US President Donald Trump says he could attend negotiations between Ukraine and Russia this week in Turkey.
I think you may have a good result out of the Thursday meeting in Turkey between Russia and Ukraine. And I believe the two leaders were going to be there. I was thinking about flying over. I don't know where I'm going to be on Thursday. I've got so many meetings. But I was thinking about actually flying over there. There's a possibility of it, I guess, if I think things can happen. But I would fly there if I thought it would be helpful.
There's a possibility, I guess. Bloomberg's Oliver Crook is in Brussels for us, and this is certainly one of the things that's very much on the minds of finance ministers as they gather in Brussels. Ollie, could President Trump move the needle then on ending the war? What's the expectation for Thursday?
Yeah, when we look at sort of what the Trump administration has been trying to do, it has been trying to push both Ukraine and to Russia into yes or no scenarios. And they want to discover who is going to be the bigger no in the negotiations, who is going to be the bigger obstacle to peace. Over the weekend, we had these discussions with Emmanuel Macron, Keir Starmer, Friedrich Merz, and Zelenskiy in Kyiv. Apparently, they spoke to Donald Trump on the phone. They came out with this proposal for a 30-day ceasefire, with which Putin then sort of rebuffed and said, why don't we have these talks on Thursday in Turkey? He did not offer himself as the sort of key negotiator there, but then immediately President Zelensky said, listen, I will be there on Thursday. I'm ready to discuss. And if you are ready to be there, Vladimir Putin, I am ready to talk to you. This is all part of the Zelensky strategy to basically be not the obstacle to peace, to never be the sort of obstacle in the eyes of the Trump administration. This is the lesson that he learned from that Oval Office meeting. And now the ball is in Putin's court. So the outcomes could be that Putin decides, yes, we're going to have this meeting. I think that's a very difficult thing to envision at this moment. And then if he does say no, at what point does that trigger within the Trump administration determining that Russia is actually the obstacle to peace? And if that is determined by the Trump administration, we do now have potentially a new list of sanctions that was put forward by Lindsey Graham, the U.S. Senator, that basically what Graham calls bone-crushing sanctions, which would look to basically target third-party nations that are buying oil and gas, uranium, those sorts of things from Russia. It would impose 500% tariffs on goods from those countries into the United States. This would be sort of a major escalation in terms of sanctions and a new sort of technique in trying to put the squeeze on Russia if indeed the United States were to determine that Russia is the obstacle to peace. But again, at this stage, we're still in the early stages there. We'll see sort of what materializes. We also don't know what an outline of peace could even look like. We saw the sort of early proposal from the United States. But again, there's a lot that we don't know. But this is all part of the sort of Trump technique to try to bring everybody in the room and kind of improvise from there.
Yeah, exactly. What kind of result do we get out of that? We wait and watch very carefully. Ollie, let's just talk about the trade deal between the United States and the EU. It was interesting listening to Scott Bessent just a few minutes ago talking about the fact that it's unclear if there is a central thought coming out of Europe at the moment. The Italians want something different to the French, to the Germans, etc. European finance ministers are meeting. It's going to be really interesting to hear their reaction to what was just said. Also their reaction, and let's just listen in to what he had to say, to what President Trump had to say about the EU as well.
The European Union, they were the toughest of all. They were nasty. And I see that. I see that with trade, too. European Union is, in many ways, nastier than China. okay? And we've just started with them. Oh, they'll come down a lot. You watch. We have all the cards. They treated us very unfairly.
Not a fan of the EU. I think you can probably take that away from those comments that we just had from President Trump. But it's interesting the United States is still struggling to get a clear message out of the EU. Ollie, just talk us through, kind of the impact and what prompted maybe those comments from President Trump, and also the comments we just had from Scott Bessent as well, relating to the fact that the US is struggling to hear a clear message coming out of the EU.
So listen, I think that if you were to ask the Europeans, they would say that there's a very difficult, they're having a very difficult time getting a strong message from the United States, right? The way that the United States wants to run this is basically throw up these tariff barriers, see what the countries come up with in terms of what the proposals are, and say, hey, listen, we like this, we don't like this. What the Europeans would like is much more specificity in terms of what the demands from the United States are, right? So you have this sort of communication problem. But I think that actually the very press conference in which we heard those comments from Donald Trump calling the EU nastier than China and all those sorts of things, that was a press conference about the pharmaceutical industry. That was a press conference about bringing drug prices down in the United States, while also potentially preserving the profits for some of these American drug companies by charging more abroad in other countries like the European Union. This speaks at the sort of center of the difficulty, I think, that you have for many of these European leaders and policymakers, where the Trump administration is really mixing a number of these different issues and really a lot of their gripes and putting that into the sort of trade conversation. In that very same press conference, he went on to talk about how the Europeans are suing all of their companies, suing Google, suing Apple, suing Meta, all those sorts of things, in order to sort of fund the states that they're running and their welfare states and that sort of thing. So again, this speaks at the heart of the issue that I think that the Europeans are having here, and I guess also the Trump administration, where they're not able to communicate. And let's not forget, structurally speaking, it's the EU Commission that is sort of the main competency for trade. A lot of these issues that the Trump administration wants to address are not necessarily centrally trade issues. They're non-trade barriers. So again, that makes it very difficult when you have 27 countries, as you can see the flags behind me, trying to negotiate not just on trade, but other the sort of non-tariff barriers that are really domestic issues for each of these nations.
Bloomberg's Oliver Crook walking us through the very tricky dynamics that the EU now has to navigate when it comes to Donald Trump. We thank you so much for that crucial context. Ollie there was pointing to the 27 flags behind him. I'll point you to a different set of flags. And that, of course, is in Riyadh, where we are awaiting Donald Trump's arrival. He is due to touch down at any moment. As we get news of that, we will bring it to you live right here on Bloomberg Television. Stick with us. This is Bloomberg.
So Air Force One has just landed in Saudi Arabia, the current Air Force One. Obviously, things could change on this trip. But as you can see, the 747 has just landed. It will get to the end of the runway. It'll taxi back. The president will get off. As that happens, we will continue to monitor, obviously, what is happening here. This is a very important trip for President Trump. Obviously, he is going to be doing a series of deals throughout the region, and we're going to watch that very carefully. He left Washington, obviously, with a lot of news sort of hanging over the presidency, and the drug makers are kind of front and centre in this, or at least were yesterday. So the drug makers yesterday were asked to lower their prices voluntarily in the United States. Trump is upset that elsewhere we pay lower levels of drug prices, and he wants that to happen in the United States. But what was the real takeaway from yesterday? There is one person to ask, and that is Sam Fazeli from Bloomberg Intelligence. He joins us around the table. What did we learn? What happened yesterday?
So we had an executive order from the president, and there was some detail in it, but not a lot, in the form of how exactly is this going to be achieved. The key thing, as you just said, Guy, is that he's given 30 days to the pharmaceutical industry to lower their prices themselves and come forward with some ideas. So who's going to do that? What percentage is he going to be satisfied by? Is it going to be that we're going to lower it to the level of Europe? What is the price of a drug in Europe? UK has got a price, and the actual price UK pays is not known. Germany's got a price. Maybe that's better known. France, each country has got its own price. You know, European Union isn't like, even in the US, between the states, they have different prices and different plans. So somebody needs to be talking about that. I'm pretty sure RFK Jr., who is in charge of this, will be talking to the industry to come up with a formula.
But we saw stocks weaker in the run-up to this, but then higher in the aftermath, as if the markets were fearing that this could be worse for at least US pharmaceutical companies. What does it mean for European pharma companies?
Well, anybody selling a drug in the US is subject to this, right? So they'll be asked to try and match the prices that they're asking for or people are paying outside of the US. So whether you're US or not, now obviously some US companies, so we've worked out that AbbVie and Bristol Myers have the highest exposure to the US. So that means that they're more likely to be impacted if this happens. And also you have biotech companies who only really sell their drugs in the US, so they're less impacted anyway. So Europeans will be impacted too if this actually comes to fruition.
Can you just give our kind of global audience very quickly an understanding of how the drug operations work in terms of things between patents and actual generics? Because he had specifically talked about getting more, I think, more generics on the market as opposed to kind of new drug innovation. Can you just walk us through that dynamic in the States?
Yeah, sure. There is no problem with generics launching in the US. There are some situations where the drug that they're going to compete with isn't big enough, the market isn't big enough for them to attract 50 generics. The way it works in the US, when the drug goes off patent, what you get is one generic launches for about 6 months. It's called the 6 months exclusivity. Mm-hmm. Yeah. And then you end up with 50 suddenly launching, and the price crashes.
Okay.
So, but that happens if you've got a product that's worth competing with like that. If everybody 50 come in, so that's how it goes.
Lots to keep an eye on in the drug-making space, of course, and we've seen that really move the shares on both sides of the Atlantic when it comes to pharmaceuticals. Sam Fazeli walking us through those very crucial dynamics from Bloomberg Intelligence. We thank you so much. In the meantime, we are keeping one eye on Riyadh. You can see Air Force One taxiing at the moment. Donald Trump due to emerge. But coming up, we're going to focus perhaps not only on the open here in Europe, but on a different world leader. Stick with us. This is Bloomberg.
Welcome back. Tuesday morning, the President of the United States is in Saudi Arabia. The flags of the United States and the KSA, as you can see at the top of the picture, as Air Force One taxis to a stop in Riyadh. In a few minutes' time, President Trump, of course, will emerge. He has a busy few days ahead of him. What exactly will he have to say on A, what happens in the region, and B, some of the wider trade stories? We remain very, very vigilant to that story, because yesterday it moved the market massively, what happened with Scott Bessent, and then the President's comments a little bit later having a big impact. This was the session for Europe. The white line, as you can see, rallying into the close. We went there. This is where we went out. So the rally in the United States followed. But actually, we're not seeing much of an effect this morning into European futures, Chrissy.
I don't know, a marginal partying in terms of Euro Stoxx 50 futures, higher by 0.1% to your point, where you are seeing those marginal gains, but also marginal losses when it comes to FTSE 100, underperformance right here in the UK. But I think when it talks about reprieve or a little bit of a breather, Anna, we got to take a look at S&P futures down about 0.4% as a reaction to yesterday.
Yeah, and US futures weakening just a little bit as we've gone through the last hour. Not hugely, but a little bit. Let's have a look at some of the individual stocks could be in focus whilst we're here in Europe with our focus on European stocks. Then, Critty, ABB is exploring a potential sale of its robotics unit. We knew they were planning on perhaps spinning it off, but now maybe it goes for a sale. Will that make any difference? Maybe not, but it's worth focusing on because it's a $3.5 billion business. Bayer's earnings beat estimates, new cancer and kidney drugs doing well for Bayer, and the guided higher on the pharma unit. And Sabadell in focus. It's said to have approached Unicaja investors over the possibility of a deal to avoid a hostile takeover by BBVA. We'll watch all of those stocks at the open, Guy.
Plenty of individual stock stories that we're going to be watching out for this Tuesday morning. The macro story, very interesting as well. Let's talk about this European Open. It is time for the opening trade. This is what we have, a FTSE 100 that is fairly flat, maybe also digesting some of the UK data that we've had out this morning. A little softer now, down by 0.2%. The IBEX bank story, the bank story very much in focus. They're up by just kind of 0.1%, barely budging. The stock 600 is not on the move this morning. We have barely any movement at the open for the stock 600. Yesterday was such a frenetic session. Today feels maybe like a little pause for breath as we recalculate and rework out where we're going to go next. Critty, what are we seeing from sectors?
A pause, it does seem like, when it comes to that rally. I think you phrased it there perfectly. And I'm not able to really find a coherent narrative when it comes to those early movers. You can see a little bit of a mixture, a hodgepodge, if you will, at the European Open. When you're looking at your biggest index contributors, though, I'm seeing a mix here of some of the healthcare stocks that took a beating yesterday and a little bit of technology as well. So you are seeing, again, a mixture of some of the underperformers from yesterday coming back, and maybe a little bit of a continued rally in some of the tech names that had taken a beating prior.
Yeah, worth noting that some of those healthcare stocks that were really beaten up at the beginning of yesterday made something of a comeback through the European session, but clearly had further to go because, as you point out, Chrissy, we are up by 0.7% or so on the pharmaceutical sector. So that is the best performing sector, along with autos and auto parts. That sector doing okay, continuing that sort of risk-on rally. We have financials to the downside, so insurers and banks are weaker. We've had some numbers out from the insurance sector, but it doesn't seem to be necessarily that story that is driving the insurance sector a little bit lower this morning.
In terms of the movement, you've got 300 up and 268 down. This is a really balanced market this morning. That doesn't feel like it's got a clear sense of direction after what we just had. Big kind of euphoric rally yesterday. Now questions are being asked. Obviously questions are being asked. There isn't enough detail. We don't know exactly what this trade mechanism is going to look like. We really don't know what happens next with Europe. There's a lot of things we don't know this morning, and that needs to be factored back in. So a market that feels a little bit more cautious this morning, a little bit more nervous, as we await, obviously, the next big move in this trade narrative, or maybe the next catalyst is what comes out of Ukraine, or the next narrative is what is happening in the Middle East as we watch President Trump about to deplane in Saudi Arabia. There's lots of areas to watch out for in terms of the price action, and where that next catalyst comes from, I think, is very unclear.
And we still don't have the German market open. I mean, that's not so unusual. 2 minutes past the top of the hour. But
Munich Re's down hard.
And we're waiting for Bayer as well to open, and that was a business that we did hear from, and we had got a positive update. There we go. It's up by 4%, 3.7% higher on Bayer, and that was a business that beat estimates almost across the board. They stuck to their overall guidance, but they guided a little bit higher when it came to the pharmaceutical side of things, and they did well on cancer drugs and on kidney treatments. So that's something to watch for that particular sector. But that's just one of the stock specifics we're watching this morning, as overall we see European markets, well, not going anywhere very quickly. We're pretty flat on European stocks.
Absolutely. I think it's just a reaction to yesterday still, and it feels like even at the European Open, the main story at the end of the day comes from what's going to happen out of the United States. We're getting live images as we're showing right now that Donald Trump is arriving in Riyadh. I don't think he's deplaned yet, but you can see all of the bells and whistles being brought out for that. When we, of course, will bring up that feed and the conversation there as it comes. I think it's also important to, though, that as we're talking about what's going to come out from Donald Trump's conversations in Riyadh, is what the ripple effect for in terms of European, not just trade story is going to be, but the oil story as well. And that, I think, is going to be perhaps something that is more largely priced into this market, or might have a little bit more volatility in this market that may come up. At the same time, we're also awaiting Rachel Reeves, I believe, so plenty of news happening right here in the UK as well.
Yeah, we're going to be with Rachel Reeves, the Chancellor of the UK, in just a moment as we watch the pictures emerging from Saudi Arabia. A purple carpet, not a red carpet, for President Trump as we await the arrival. The stairs have now been attached to Air Force One. It has taxied to a halt. The honour guard is in place. We await the arrival of President Trump in Saudi Arabia. I suspect that he will emerge very shortly from the aircraft once all the checks have been made. He's got a busy few days. The real question, I think, around this trip now is whether or not he ultimately emerges as part of the negotiation in Istanbul a little bit later on this week as well, on Thursday. What will happen there, I think, will be really interesting to watch in the build-up to that. Are we going to see potentially all of them in a room Thursday in Istanbul?
And he didn't seem to know whether he would be in Istanbul or whether he's on his way to Turkey after he's been in Saudi Arabia or not. He was floating that idea, wasn't he, yesterday at the White House, and we discussed at the top of the programme whether that will make a difference to the Ukraine-Russia conversation. But that is certainly we're watching. In the meantime, though, as we wait for him to come off the plane here in Riyadh, worth focusing on the themes that are going to be in focus there. Could there be money investment in each other's businesses happening? AI is certainly going to be a topic of conversation. The oil price certainly going to be a topic of conversation as the stock. I'm just looking at oil prices now, pretty flat, but that after a big rally yesterday on that sort of risk-on trade returning.
If we back out the trip to the Vatican, which kind of felt like it was that was obviously a critical necessity, very specific. Yeah. This is his first foreign trip. What does it tell us about the fact that the first foreign trip that President Trump is making is to the Kingdom of Saudi Arabia, is to his ally in the region. Also, the fact that Israel doesn't feel part of this narrative, I think, is absolutely fascinating as well. This feels related to the Gulf, not to the Gulf's relationship with Israel, which I think is interesting. There has been a big push in the past from President Trump to link those two. That is not taking place this time round. Those feel like two very separate conversations, and you've got to assume that's to the behest of the Saudis. So what comes out of this? What does he get from Saudi Arabia? What happens in the Qatar trip? What happens in the UAE trip? What is the takeaway from all of this from a business point of view, from a financial markets point of view? I don't yet know is the answer.
I think your point about prioritizing the Middle East is so crucial, because I was just doing a quick Google here of the first trips from previous presidents. So Biden's first trip was to Europe. It was a European tour in 2021. That was the very first thing on his agenda. Barack Obama before him, and I'm just doing that before, given that we're just going to exclude Trump's first presidency from that perspective. Barack Obama's first trip was to Canada. So what does that tell you then about your traditional leadership that presidents usually go to, which is your traditional allies, and Donald Trump immediately focusing on Asia and, of course, the Middle East?
I'm pretty sure he went pretty early in his first presidency to the Middle East, to Saudi Arabia, and there was a lot of pageantry that time around. I seem to remember there was also dancing. I don't see anybody ready to dance on that purple carpet right now, but you never know.
No, but I suspect that there will be a lot of adulation as we work our way through this trip over the next few days. He is certainly welcome in this region. The Canada trip maybe would be slightly more tricky, I would imagine. Anyway, we will continue to monitor what is happening with the pictures coming out of Riyadh, and we will watch and await the president arriving there. In terms of the stocks that we're watching, quick look at the Core 6. Schneider, I think, has gone ex-dividend this morning, so just be aware of that as you watch that second from the right. But elsewhere, we are seeing a little bit of strength coming through. Chips are up a little bit. Luxury stocks are up a little bit. The pharma sector, though, is firmly in focus. As we continue to monitor the situation in Saudi, let's turn our attention, though, to the stocks we are watching with Joe.
So just wanted to take a look at the renewable stocks today, Guy, because we're seeing some big moves in this sector today. Take a look at Vestas, up around 9%. Ørsted up 8%, EDP a similar amount as well. Now, we got news last night on the regulation in the US, and there were fears that a lot of the main Inflation Reduction Act measures would be fully repealed, but that hasn't happened. And actually, it looks like some of the tax credits for US projects on wind in particular potentially going to stay in place for a few more years than expected, and that is being taken very positively by the market today. We can see those stocks really jumping on news of that phase-out coming, but not as quickly as expected. That is seen as a positive there. Then, in terms of the big German firms reporting today, Bayer, first of all, a decent gain on that. As mentioned earlier in the show, it looks like the oncology drugs doing well, in particular also kidney as well, so a big boost for that one. Has been pretty beaten down given the litigation issues, potentially bit of a rebound on that one. Then Munich Re, this is a dropper linked to the exposure to the LA wildfires. Munich Re today saying that it's going to cost them around 1.1 billion euros in exposure following those fires over in California, so that is getting a hit on that news there. We're down 4% for Munich Re this morning. Then down in sunny Malaga, probably my favourite city in Spain, Unicaja on the radar, coming in to the situation in terms of Spanish banking. Sabadell speaking to Unicaja potentially and investors around a potential tie-up, trying to fend off their northern rival BBVA coming in for them and doing that hostile takeover bid. A bit of a Spanish geography lesson as well on that one, but we are seeing a little bit of movement in Unicaja. We're up around 0.7% for that one. Then finally, just on pharma, a bit of a rebound again. As said earlier, the big losses yesterday following news on the drug pricing in the US, but continuing to rebound, something we saw in Asia as well. Pharma in focus once again this morning.
Joe Easton from our equities team walking us through some of those movers. I just want to harp very quickly on one of the key movers that Joe had mentioned, which, of course, is what's going on in Spanish banking. Banco Sabadell having a little bit of a U-turn. I'm not seeing a ton of volatility or a ton of trading right now in the stock, but this is a place we want to keep an eye on, given that its stock has rallied so much in the proposed acquisition, the hostile takeover bid from the likes of BBVA. The Spanish government now trying to find an alternative for Sabadell to find a fight off that hostile bid. Our incredible banking team over in Madrid, as Joe was saying, talking about a potential bid from Unicaja. That is a really crucial one when we talk about that major company and whether or not Sabadell actually takes it. What does it value in terms of a bigger player in the Spanish banking space like BBVA versus a smaller player and the tie-up there? It really changes the structure of that bank, and we'll see how that all shakes out.
OK, so that's the Spanish banking sector. We're watching that for movement. Let's widen the conversation. Talk to Louise Dudley, Global Equities Portfolio Manager at Federated Hermes. Louise, thank you very much for joining us. We've got our eyes on so many different moving parts this morning. We're talking about the UK investment landscape, hoping to have a conversation with Rachel Reeves shortly. We're watching the live pictures coming to us from Riyadh of the president arriving there with that Saudi-US dialogue taking place. But take us back to the markets then, Louise, because we've got stocks pretty range-bound this morning after yesterday's excitement. Is the excitement of yesterday behind us?
I think so, at least for now. I think definitely, how much this has de-escalated the tensions is significant, and I think a lot of companies are kind of taking stock. But I think there's still, a lot of uncertainty still going forward. That move away from those more defensive assets has definitely happened. And so to a certain extent, that's an opportunity for longer-term investors to think about, particularly given we've come through earnings, we can see those longer-term expectations coming in, to rebalance and take opportunity actually from that volatility.
Have we learned anything yet about, can we take any firm conclusions, make any firm conclusions about the trade narrative out of the US? I was jotting down a few things. I mean, sectoral tariffs seem very hard to shift. Those base level tariffs of 10% seem very hard to shift. So there does seem to be a sense that even when you get deals done, that it's not game over for tariffs.
No, and I think it will be ongoing as well. How long will they persist? That's still very uncertain as well. We've still got some of the kind of original tariffs from Trump's first term that are still in place. So, if that were to happen, that's, a permanent kind of correction within the market that companies need to move on from. But because it has been lessened so much, I think we're going to see a lot more companies able to absorb those pricing changes within their supply chain, so perhaps less of an inflationary impact, but that is still to come within the market, and we haven't yet seen that coming through.
Is it easier for companies now to guide? Can they? The issue that we have at the moment is that companies have no idea. On all the kind of guidance we're getting in terms of the corporate numbers that are being delivered are, we don't know. Do you think there's now a case to be made that they can know, and therefore the guidance becomes more accurate, their stocks become more easier to price?
I think from an investment standpoint, we obviously have to price the companies and, and our expectations. Yep. I think on the companies level, I don't think they're that incentivized to put out any additional revised guidance.
So that hasn't changed as a result of what we've seen over the last few hours, last 24 hours?
I don't think so. I think they can still say that there is a lot of uncertainty still in terms of how those tariffs get embedded within the market and how the consumer reacts. We've obviously still got high interest rates in general across the world. And so, that consumer sentiment and that buying power and everything else, I would still say, they're not incentivized to adjust their guidance at this time when so many things are moving, particularly also on FX. We've seen big moves on the dollar that impacts a lot of companies. OK, I just want to take, just hold that thought. We'll be back with Louise in just a moment. I just want to take you back to Saudi, to the Kingdom of Saudi Arabia. The Crown Prince is shaking hands with the President of the United States, who has just arrived in Saudi Arabia. You can see him arriving at the bottom of the stairs after exiting Air Force One. And President Trump is in Saudi Arabia, has just shaken hands with the Crown Prince. This is a big trip for him. Obviously, the trip around the region is going to be extremely important as well. But it's fascinating that these two that it's so important for President Trump to go here first, to arrive, meet a relatively kind of strong leader. Yeah. He gravitates towards leaders like this, and I'm just kind of wondering, therefore, what that tells us. You were mentioning Canada a little bit earlier on. It tells us so much about his view of the world and the fact that he is here and how important that this region is to him. I think it's fascinating. It just speaks to, I think, the Trump doctrine, as it were, about how he sees the world. Yeah, I think it's crucial here. And you mentioned, I was talking about Canada, but I did a quick Google after that. So Barack Obama and George W. Bush's first foreign trips were to Canada. Joe Biden's first foreign trip was to Europe. Both of them in the hot seat right now with Donald Trump. I've seen domestically, when you're talking about, a lot of Americans are looking at this relationship with Saudi Arabia, and there are questions being asked about that friendship when it comes, especially in the context, not just the oil story, which of course is a hot topic, but the story under Jamal Khashoggi as well. And you know that at the end of the day, Joe Biden did not have as friendly of a relationship with MBS as Donald Trump did. And we know that Trump, yes, in his first presidency had a friendly relationship there, and it has been an important ally for the United States in various phases.
is. And now let's pivot back to the UK narrative. I mentioned to Louise that we were watching news on a number of fronts, and one of those is around the UK finance industry. UK pension fund managers have agreed to invest at least 5% of their assets at home as the government seeks to boost investments. Let's go to Bloomberg's Lizzie Burden, who brings us a conversation with the Chancellor of the Exchequer. Lizzie.
Thank you, Anna. Thank you so much. I'm pleased to be joined by the Chancellor herself, Rachel Reeves. Chancellor, I want to start with this conflict at the heart of this policy between maximising returns for pension funds and boosting UK economic growth. Clearly, we'd all love to see both, but what's your top priority?
Well, we do need to achieve both, and we improve returns for savers in the UK. And I know that people every month that save for their pension are making big sacrifices in doing that. I want them to know that they're getting the very best return on that money, which means a more diversified portfolio, including investing in fast-growing businesses and also in infrastructure. And what's welcome today is that 17 companies representing 90% of active pension savers have signed this accord, which means that now 10% of what they invest will be in these private assets. And for the first time ever, a proportion of those, half of those, will be in UK assets. That's good for the UK economy, more money into the UK economy, but it's also good for savers.
So if you're confident it's good for savers and for the economy, why not mandate these pension funds to invest in UK assets?
We don't need to mandate them if people are willing to sign a voluntary accord. And today we've shown that that is possible, with 17 businesses representing 90% of active savers signing up voluntarily to this, because they know that it is in the interests of the savers whose money they invest. The challenge up until now has been that no company wants to go first. And so this coordination, that's the role that government can play. And the work that myself and our pensions minister, Torsten Bell, have done is to bring the industry together in a way that hasn't been achieved before, to ensure that the market will move together and send a very clear signal that the best way to deliver for savers is to have a more diversified portfolio.
But if they don't comply, because a one-year review of the original Mansion House Compact showed only limited progress in terms of assets invested, is there a point at which you would mandate pension funds to invest in UK projects?
I'm never going to say never, but I don't think it's necessary. Because what we saw today was 17 pension funds representing the vast proportion of pension savers in the UK deciding voluntarily to do this. And what they wanted was a government that was willing to corral and bring together the industry to ensure that they can best ensure that their savers, their customers, are better served. And so I'm really pleased with what we've been able to do. It shows that you don't need to use mandation if you can work together, have that compelling argument, and also crucially, and this is so important, have the pipeline of investments. Because another thing that pension funds have said to me is, we'd love to invest more in private assets, we'd love to invest in infrastructure if we had that pipeline of projects. And that's what our 10-year infrastructure plan will enable. There's a number of investable projects, whether that's the Lower Thames crossing, whether it is investment at Heathrow or Euston Station, or projects around the country, from rail in the north to gigafactories. There's so many investments that can be made, but that plan gives them that.
Why focus on private markets when the London public market needs such help? There's a stark valuation gap between the UK and the US. Why not help out?
Well, of course, AIM shares are included in this, so it's not the case that no listed equities are included in the announcement today. But what start-up and scale-up businesses say to me is that they end up listing abroad because they raise capital abroad. And one scale-up business, a really successful UK scale-up business, said to me was that every time that they raise money, they become a bit more American. And so the point here is that our fast-growing businesses will be able to raise money through that long-term investment from pension funds, and therefore will stay in the UK and will list in the UK. So this is good for UK stock markets too.
Well, you said never say never on mandation. Would there ever be mandating to invest in UK-listed equities?
I think that what we've done today shows that we don't need to use mandation.
But you're not ruling it out?
There's a willingness from businesses to do this voluntarily in line with their fiduciary duties to ensure best value for their savers. And today just shows what government and business can do, working in partnership, delivering for working people who in the end are going to be forefront of our minds, because it is their money that is being saved, their money put aside for retirement, and we've got a shared interest, government, business, and most of all on behalf of working people, to ensure that that money works for them.
Chancellor, if we can turn to another issue top of mind here in the city, are you concerned that your non-dom tax changes will cost more than they raise?
No, I'm not concerned. We've had numbers produced by the Independent Office of Budget Responsibility, who forecast that a combination of those rules, but also the temporary repatriation facility, will bring in money for the Exchequer. When I became Chancellor last year, I faced a big black hole in the public finances. We needed to take immediate action to deal with that. We made a manifesto commitment to ensure that non-doms do pay their fair share of tax in the UK, but combined with a temporary repatriation facility, which makes it easier for people to bring money into the UK without facing punitive tax, is what has convinced the Office of Budget Responsibility and other forecasters to say that this will raise money for the Exchequer, money that's much needed to invest, for example, in defence.
But the OBR's modelling assumes that non-doms won't leave as a result of your policy,
not
and
true.
they've admitted that it's very uncertain.
The Office of Budget Responsibility do forecast that a number of non-doms will leave the country, and indeed every year you have huge flows of people in and out of the country. This is a highly mobile group of people, but as well as people leaving the UK for a whole variety of reasons, we have every year thousands of people, including some of the wealthiest people, come to the UK because they can see that this is a great place to do business, a great place to grow a business. And you saw yesterday in the immigration white paper a real shift in our policies around immigration towards higher skill, higher value people coming into the UK to better support our economy.
And Chancellor, I was interested to hear the Prime Minister saying that immigration doesn't boost economic growth. That directly contradicts the OBR. So who's right, the Prime Minister or the OBR?
Well, of course, immigration can be good for the UK economy, but you've got to get the right type of immigration. Just bringing in more low-skilled workers is not going to make people here in Britain better off, and that is the number one priority of this government. We do need to get the numbers down. More than almost 1 million people net migration is a city the size of Birmingham coming into the UK every year. That's clearly not sustainable for our public services, for our housing. And when we've got 9 million people in the UK who are economically inactive of working age, it's quite clear that our priority has got to be, as it is through our welfare reforms, of getting people back into work by giving them the support and training that they need.
If more people doesn't necessarily equal more growth, though, does that rule out the government agreeing to a slimmed-down version of the EU's youth mobility scheme?
Well, we've got the EU-UK summit next Monday. Negotiations are ongoing ahead of that. But we were clear in our manifesto, there will be no return to free movement under this Labour government. You can see that finally we've got a government that is trying to get a grip of uncontrolled migration. But of course we want Britain to be a place that welcomes entrepreneurs, researchers, the best talent, because that is something that makes our country a great place.
Chancellor of the Exchequer, Rachel Reeves, it's always a pleasure to talk to you. Thank you so much for making time.
And you.
Well, we heard from the Chancellor there off the back of this newly signed Mansion House Accord with those 17 pension funds not ruling out mandation somewhere down the line. I thought that was a really interesting line out of that conversation. Back to you.
Lizzie, thank you very much indeed. Lizzie Burden speaking with the Chancellor of the Exchequer, Rachel Reeves, here in London. A number of different lines coming out of that relating to what is happening with the non-dom policy and the impact that's going to have. The migration story, which you heard announced yesterday by the Prime Minister. And, of course, as Lizzie says, what we've heard in terms of the pension plan. Let's get Louise Dudley's reaction to this. Global Equities Portfolio Manager of Federated Hermes. How attractive is the UK as a place to do business? And what does the Chancellor need to do to improve it?
Yeah, I think it's certainly been better over the last couple of years than it had historically, which is positive. And I think, but, you know, lots of the biggest companies are obviously global companies.
Yep.
There continues to generally be an issue around pay. I think a lot of the UK companies often talk about it's an issue in terms of getting higher pay that is competitive, with the US pay being so much higher.
Senior execs here,
senior execs. But also in terms of kind of the competitive landscape, that, you know, there isn't maybe that flow of younger companies coming through that can be an issue. That said, you know, UK companies, you know, we certainly have exposure within the UK, and certainly these, you know, kind of longer-term aspirations in terms of flow into the UK market, I think, are a positive for the equity market.
Louise, anything briefly that the Chancellor can still do to encourage more listing in the UK? She was quoting there a business that said, every time we raise money, we become more American. And that's not what the Chancellor probably wants to hear.
Yeah, I think it's hard. I think there's kind of positives and negatives in terms of listing in the UK. I think these movements, I think the DC market from a pension perspective is obviously getting a lot bigger within the UK, and those voices maybe are not as loud as they could be within the investment community. So perhaps that would help. But, you know, I think they're always going to look to the US, which is a deeper market from a liquidity perspective. Hopefully some of these changes will help from that perspective.
Louise, thank you very much. Thanks for joining us. Louise Dudley, Global Equities Portfolio Manager at Federated Hermes. We will have more coming up. We're watching President Trump and his visit to Saudi Arabia, of course. We were looking live moments ago at some images coming to us from Riyadh of him in conversation with Mohammed bin Salman. We didn't have any audio on those, but we will certainly be following the narrative as it develops during his visit. Lots more to discuss. This is Bring Back.
This is the opening trade about 30 minutes into today's session. Meager gains on the benchmarks here, higher by 0.2% of the stock 600. When you look at the DAX, for example, virtually flat. The FTSE 100 in the futures picture, at least at the open, was lagging behind the other indexes. And now it looks like we are, I'm going to just go ahead and call it flat across the board. And Dan, I think that really tells us something about where we are in this environment. No one's running away with this narrative. No one is saying we want to dive into the equity picture right now. A little bit of wait and see, a little bit of caution, but certainly not outright selling either.
Yeah, absolutely. So it feels like a little pause, doesn't it, as you say, after yesterday's excitement. Very much risk on yesterday in terms of global equity markets and other asset classes. And today looks a little different. US futures pointing a little bit lower. Let's bring into the conversation Sarah Ketterer, CEO of Causeway Capital Management, which has over $55 billion in assets under management, and visiting us here in London. Sarah, very good to have you with us. Thanks for joining us. So yesterday was very risk on. The markets got very excited by what we saw in this sort of interim agreement between China and the United States. It was an interim agreement, though, wasn't it? I mean, where do stocks go? Big question, big picture. Where do stocks go from here? Where do US stocks go from here?
No pressure.
Because, well, I'll give you two ways out of this, because the UBS is cutting its US stocks to neutral. On the other hand, we've heard from parts of Goldman Sachs saying they see US stocks going higher from here. You know, so what's your best call?
Well, the U.S. market is still demonstrably more expensive than that of the non-U.S. markets in aggregate, but financial conditions are relatively loose still. So there's likely to be more equity investment. Investors who might have pulled back in fear of the tariffs may very well be interested in returning to equities. So it looks reasonably good, at least for the next 90 days, as you note. But the key is whether or not companies are willing to spend, and this is industry specific, but are they willing to put the capital expenditures out there in order to get the returns? Are they still cautious? And what we're hearing for companies is a mixed picture. Some are still very concerned.
Right, that's interesting. So where are we seeing that concern? Where are companies not wanting to do that investment?
Well, where there are still sectoral tariff, that is an issue. I think pharmaceuticals is sort of interesting example where perhaps bringing some manufacturing to the U.S. makes sense, but how much? And what will the return be? And then there are other areas where, say, low-end electronics, where there's just so much caution and moving to other Southeast Asian countries, getting less exposure to China is the watchword, less so moving to the U.S.
Let's talk about tacos. This has been the kind of running joke throughout the show. The joke floating around is that this is a taco market. Trump always chickens out. He starts kind of big, a lot of bluster, everybody gets very concerned, but ultimately he does chicken out because the market tells him to. Is that the way we should be thinking about this? I.e., you want to look through all of the pain, stay invested, and keep with this market?
Yes, you do want to stay invested, definitely, but there is a result of this Trump tariff war, which is average tariffs now are 14%.
Yep.
The U.S. is levying on imports, and thus far, anyway, until we know what happens at the end of the 90-day periods in July and August. That's 7 times where they were before this began. So there will be an impact of this. It's just not going to be as horrendous as what we expected just a few days ago.
A recession? Do we put a recession? Like, how do you frame this in terms of the way you're thinking about it? Because it feels at the moment like there were these massive tail risks, particularly on the left-hand side, kind of the US economy, the global economy was going to roll over in significant fashion. Has that now been removed as a substantial risk? We are now in a more benign environment, and therefore it's an easier investment
Very
environment.
likely a recession isn't going to happen. It was a self-induced shock and now being rolled back.
Yeah.
But this will lead to some slowing. There's some inflationary impact of this. What we ask companies at Causeway is how much of this increased cost, this tariff, will you be bearing versus you'll be passing on in terms of price, and the consumer will be bearing it. And they're not sure yet. They don't quite know to what degree the consumer in the U.S. has the ability to pay more.
But retail sales are out, what, Thursday? We're going to get...
On Thursday, got sentiment on Friday as well out of the UMISH data. But, Sarah, you led me right to that point, because if you look at personal savings as a percentage of disposable income, it's taken just a cliff dive after COVID. But it is still at elevated levels historically. So talk to us a little bit about what you're hearing from those clients that you're speaking to that are saying, well, we might pass this on, but they can take it.
Well, the lower income consumer, we think, is under a significant amount of pressure, which is why the fear of unemployment could lead to significant concern about spending and a reduction in spending. The credit is out there. We have student loans have to be repaid, so there are all kinds of pressures on that particular consumer. The very high-end consumer is likely to be reasonably resilient. And then whatever tax policies come out of the Trump administration, we have to weigh that in as well. But it looks reasonably benign for the U.S. consumer at present, barring something unexpected, which is likely.
Everything seems unexpected. I expect nothing.
On the tariff front.
Well, so that's the consumer side of things. Let's talk about the corporations, or at least I'm going to go with the S&P 500 corporations that are taking on some of those costs and are looking at the ports, et cetera. Is there a world here where they have because they also have a lot of liquidity on their balance sheets relative kind of post-COVID level that's still sloshing around. Is there a world here where the corporations take a hit on their margins to keep the market share of their consumers? Is that the way out of this?
Yes, and one of the most obvious industries for that is autos, where consumers they just don't have a lot of room to pay more. And the automotive companies have significant tariff pressure if they're outside of the USMCA agreement. So any sort of imported autos will certainly be passing on, or try to pass on in price if they can, but most can't. And that's one of the reasons why we think the automotive industry is not a very attractive place to be investing at present.
Because they don't have that liquidity on their balance sheet, or
they
because
don't have pricing power.
Yeah.
And therefore, they'll take it in terms of compressed margin.
Yeah. Thinking about pricing power and which sectors to get exposure to takes me to pharma, because President Trump does not want pharma to have as much pricing power as he thinks it does in the United States. Where do you, when you look around the pharma space, I know you've spoken favourably about the European pharma sector of late, Sarah, so where are you looking for opportunity?
Both Europe and the U.S. there are value pharmaceutical stocks, very interesting companies that have pipelines that are underrepresented in their valuation. But we think that a lot of this is political bluster, that ultimately the pharmaceutical companies will continue as business as usual.
Let's take a step back from all of this. So the pharma kind of story continues. The auto sector, it's very sector-specific. Broader market. Is the US still exceptional? Are there better opportunities in Europe? How do we think of... Scott Bessent was out this morning saying, basically seeming to push the kind of the EU tariff story further away, and we're not going to get a deal anytime soon. Does that preclude investments in Europe and return money back into the United States. How are you thinking about the kind of the various markets, the various buckets? Do I simply go back to US exceptionalism as a result of what's happened over the last few days? How easy is it to invest in Europe at the moment with so much uncertainty that still exists around here?
Yes. The U.S. is exceptional, but so is Europe in its own way, and now Europe's under a lot of pressure in order to spend. Germany leading the way with fiscal expansion where there is room to do so, and that should be stimulative for Europe. The EU capital market, the harmonized capital market, if that actually happens, would be transformative for Europe.
Yeah, I agree with all those things, but there's so much uncertainty around Europe. The only certainty seems to be that the Germans are going to spend more, but we don't know kind of over what time period that's going to happen.
Like, European stocks are demonstrably cheaper than that of the US.
But they have been for years.
Yes, but the gap became historically wide at the end of last year.
Yep.
And it's only closed a bit. So you get, for your money, more from Europe than you do from the US. So the US can continue to be exceptional, but Europe has a lot of upside just in a value re-rating upward.
How much of the trade deal with Europe matters, though? If we're talking about this kind of fiscal injection into Europe, we're saying that the inflationary aspect in terms of trade may not show up as much in Europe. In fact, it may be deflationary if you see more of that kind of product rerouted. How much of a trade deal matters? As we just heard from Scott Bessent, that the EU is complicated, doesn't speak with one voice. No friendly feelings from Washington there coming to Europe. Does it matter, though, at all?
Yeah, it does matter, particularly in agriculture. And actually, agriculture is likely where the greatest amount of disagreement resides. So there will be concessions. Europe will make concessions. The U.S. will make concessions. But Europe isn't the enemy. The trade enemy is China. And that was dealt with yesterday, at least for the next 90 days. So it's very likely that some of this is, again, remember, part of this tariff effort is political. It's to show the Republican base in the U.S. that something really important is happening that will benefit them and their livelihoods and their jobs.
Where does energy fall in all of that? Is there an LNG story here that we still need to pay attention to, or is that in the rearview mirror?
Well, the lower oil prices go, the more interesting energy stocks become, because the next phase is usually up, barring a recession, and we spoke about that earlier. That's unlikely. So as supply becomes abundant and oil prices fall, energy stocks now are definitely a possibility in the portfolio. We like income, so we're interested in integrated energy, oil and gas companies, as well as some of the more dominant E&Ps that produce at low prices.
Yeah, collect those juicy dividends, a little a la Exxon. Sarah Ketterer, CEO of Causeway Capital Management, walking us through the dynamics in the States and perhaps how you play it, as, of course, we are hearing from Donald Trump and Scott Bessent in Riyadh.
OK, let us pivot the conversation to get another perspective on markets, essentially. Our Markets Live executive editor, Mark Cudmore, joins us now for 3 minutes on the markets. Mark, just having a conversation there about global asset flows. I suppose the markets at the moment, though, they just feel as if they're all about that marginal news flow, marginal trade news flow. Is there more to markets right now?
I think trade has clearly been the dominant story, and I think in terms of that marginal news flow and trade, we have known since Liberation Day and then the subsequent 145% tariffs in China that the marginal news flow could only be positive from there. It was positive into a structural, tough story on trade, but that was where the marginal news flow is. I kind of am in the camp that yesterday was an inflection point, where from here, the marginal news flow on trade specifically can only be negative. Given that we've seen such an aggressive reduction on the prime trade target for the US, that means that everyone's expectations that everyone will get a good deal. But on the flip side, we know that both in the UK and China that 10% is seen as the new minimum, and that also this is only suspension of the higher level of tariffs. It's going to take a long time to get concrete kind of material deals over the line, which means we're still heading into a world with a much, much higher average effective tariff rate for the US than existed a few months ago, which means the cost of business in the US is much more. And therefore, not only do we have the structural negative story that's been there for the last couple of months, but we've gone from a marginal positive news flow story to, from here on out, a marginal negative news flow story on trade specifically.
Mark, I'm exhausted. I'm pretty sure you're exhausted. Are the markets exhausted?
I think they are, definitely. So what happens in that environment? I think that means that no one wants to trade a bearish view very aggressively. And also, I think there's a lack of enthusiasm to run higher on this bullish story. you can't argue the fact that there were higher expectations yesterday and Bessent still exceeded them. But the fact is there's only a suspension. We don't have much concrete kind of wins yet. So therefore, the trade scenario is still quite negative in the backdrop, which is why you're seeing poor price action in crypto and Hong Kong stocks, in the dollar. There's lack of enthusiasm to take this clear win from yesterday higher. So I think from here, we're a little bit of in kind of waiting for the next catalyst to go somewhere, which is where we might bounce around in the short term. But to me, the structural story turned materially more negative a couple of months ago. And that's the longer term story. We're still trading and nothing has changed on that.
Mark, very quickly, where does that leave the dollar? We were looking at financial conditions indexes. They've come back up because the stock market, the credit market, and arguably commodities markets has shown up yet. The dollar is lagging. What does it take for dollar bulls to win here?
They won't win, ultimately. The long-term dollar decline has been set in motion by Donald Trump a couple of months ago. It was when he first undermined the Fed and with his trade war, making it more expensive for American businesses. So we have a world that was overexposed to the dollar. This is not all to put it all on Donald Trump. He was in a situation where the dollar probably was set up for a decline anyway. He just provided the spark, the catalyst. The long-term dollar downtrend is in place for the next couple of years. Over the next week or two, I have no idea, but dollar bulls won't ultimately win.
There you go. Mark, thank you very much indeed. Mark Cudmore joining us on the latest on these markets. MLIV Go is the function, of course, if you want to follow Mark and the rest of the team. The President of the United States is in Saudi Arabia. All eyes are on Riyadh. We have US tech leadership in Saudi Arabia right now in conversation with Sarah Eisen. Let's take a quick listen to what they are saying as to how they see the future going forward.
Mouse to touch. One thing that AI is doing right now, as computers now understand human language, it's fundamentally changed how we interact with any computer, and I think we're very excited about that change that is coming.
Ahmed?
Yeah, I think the things that excite me the most are kind of in the research area. So the ability to do, discovery, and AlphaFold is a perfect example, but I'm talking about maybe, for example, the physical chemistry world, material discovery. There's just so many possibilities of taking all the science and knowledge of humanity and accelerating that experimentation process, which we're going to be able to do today. I mean, we are already finding huge results. AlphaFold's a great example. In the physical chemistry world, we're also working on things. And as we bring robotics into this and embody AI, then that last bottleneck of taking the AI to the real world is going to accelerate discovery and the change of this world.
I'm going to do one more lightning one because you're all here, and I think everyone's very interested to hear from you.
Welcome back to the opening trade. 48 minutes into today's session. Green on the screen, but marginal gains. We are seeing a little bit of a recovery. We did see the stock 600 open in the red, but higher by about 0.2%. Wait and see, I think, seems to be the message from the stock market, the bond market. I'll argue even the FX market as well. The real conversation, Guy, is ultimately, what do you take out of these negotiations? Positivity between the U.S. and China right now. Positivity between the U.S. and we'll throw Saudi Arabia in there. We'll throw Qatar and the UAE in there as well. Europe, not on the nice list for the U.S.
The way that President Trump speaks about Europe just continues to amaze me in terms of the kind of the vehemence in the language that he uses. So earlier on we heard from Scott Bessent and his commentary obviously is coming out of Saudi Arabia as well. Kind of paraphrasing the comment that often is ascribed to Henry Kissinger, who do I call if I want to call Europe? His line was, this is the Bessent line, apparently the EU may have a collective action problem when it comes to trade. Let's listen to what the Treasury Secretary had to say a few minutes ago.
Europe may have a collective action problem, that the Italians want something that's different than the French, but I'm sure at the end of the day, we will reach a satisfactory conclusion.
At the end of the day may be a long one, though, and that is, I suspect, going to be something that EU finance ministers gathering in Brussels will be thinking about today. There we find as well our own Ollie Crook, who joins us from Brussels. What will the European leaders make of that comment, do you think, Ollie?
Yeah, I mean, listen, Guy, there is a degree to which, and this is probably no secret to anybody who spent any time in Brussels, that, collective action problem may be part of the EU's kind of middle name. And that is what this whole institution is sort of made to, in order to broker, is to basically deal with the very varying interests between 27 different member states on very, very complex issues in a sort of supranational level, but obviously affects, 300 and some odd million people's daily lives. And that is the problem within Europe. And the competence within the European Commission to handle trade makes it even more complicated when the United States seems to want to take some of the issues that are not strictly speaking trade problems, such as in so-called non-trade barriers. This could be touching anything from regulation, from taxes, and those sorts of things. This is not an institution that can rule by executive order like the Trump administration is doing. So when you try to sort of present a full menu to the Trump administration in terms of what can be on the table for negotiations, the Europeans just don't really have the inclination or the power, we should say, to present the kinds of things that a sovereign nation, particularly with a sort of much more centralized governing force, can do. So really, and we should also add that this is a $1 trillion trading relationship, right? This is the biggest trading relationship between two blocs in the entire world. So for both sides, the Europeans and the United States, this is something that they both need to get right. So for that reason, and again, the complexity of those negotiations, I think it's probably fair to say and likely that that is going to take a much longer time. But as you say, Guy, I think that one of the things that, the Europeans really react to is not necessarily that they want a rebalancing in the U.S. trade, but really the tone in which the Trump administration talks about the European Union.
Yeah, there's certainly quite a lot of anger there, isn't there, Oliver? Anyway, I found it. I was digging through my notes to try and find when did we hear from Scott Bessent downplaying how quickly we get a deal on China. It was Tuesday the 29th of April, and he said, look, we've put China aside. We're doing another 15 to 17 deals right now. India may be first. And he basically was steering everybody away from watching China and suggesting that that deal wasn't coming quickly. Well, we haven't had a full deal, but we have had this interim agreement at least. So it's worth noting, of course, that the US administration is still pretty angry about trade with Europe, but it doesn't necessarily tell us anything about when a deal comes.
No, and I think that, you see there are different pressures that will be sort of exerted on the Trump administration and sort of, all these other sort of external pressures that could mount over time. They may need the Europeans on this subject or another. But again, I think that there has really been a focus for the Trump administration. When you think about trade, one of the biggest sticking points I think Trump has had since the very beginning is the question of cars, right? The cars is a sort of great national symbol, and he's very, very upset about the arrangement in terms of the volumes of flows of cars from Europe into the United States. I mean, he said, in Munich, you don't see any, I don't remember which brand it was, any sort of Chryslers, or it probably wasn't Chryslers, you don't see Chryslers anywhere. But that this is really one of the focuses for the Trump administration, is wanting to right those imbalances. And again, and I think that it also comes probably from the first term of Trump. When you remember back in 2016, the way that the European Union and, was dealing with the Trump administration, this is a very different world. And this is one in which the Europeans realize they do need to negotiate. They do want to get on side. And of course, there is such a dependence on the Trump administration from the European side, not just on the trade relationship, but to get on board with the question of Russia and getting to a sort of equitable peace in the conversation with Ukraine. And of course, the defense and all of these things get mixed together. I mean, you see it also within Brussels. You see some of the antitrust action from the EU. It has not been as hard as many people had anticipated, and probably how as hard it would have been under a different presidency. You have these new sort of regulations that now this EU Commission has. They are not levying them, and this is all down to the Trump administration.
Ollie, that's just on the trade front. In the background, there's also, of course, the question of Ukraine that is being discussed. I think over the weekend, again, the image that really struck me was Keir Starmer, Emmanuel Macron, Donald Tusk, and Friedrich Merz all around the table on a phone. Notably absent from that was Ursula von der Leyen. Talk to us a little bit about the kind of dynamic here between the EU leadership and the country leadership. Who's winning out there?
Yeah, I think that when it comes to these sort of discussions about the ending the war in Ukraine and sort of building the relationship with Donald Trump, you really need to build on the sort of individual level. And this is something that, Keir Starmer has learned. This is something that Emmanuel Macron has learned. And again, when you talk about those four people sort of sitting around the table with a phone on the table, at one point, the person on the phone on that table was Donald Trump. And this was part of their sort of conversation to try to get that 30-day ceasefire, which would have taken effect yesterday had Putin basically said he was not interested in a ceasefire and is instead interested interested in talks. And again, this is the important point here, is that these leaders need to build these interpersonal relationships with Donald Trump. They need to get him on side. We do not know really what the U.S. administration thinking is publicly in terms of what kind of peace they want to see in Ukraine. If you look at the draft that they put out a month ago, to many of the European eyes, that looked just like basically not a full surrender to Russia, but giving in to many of those demands. So, but since then there's been that discussion between Zelensky and Trump at the Pope's funeral. Maybe there's a little bit more seeing eye to eye. But again, I think for the Trump administration, as far as Ukraine goes, the whole idea is to push both Ukraine and to Russia into each of them having to say yes or no to American proposals, and the ones that say no are going to get the sort of ramp up on sanctions or have the U.S. walk away.
Bloomberg's Oliver Crook walking us through some of those dynamics in Brussels right off the heels, of course, Scott Bessent with a not-so-positive tone on Europe out of Riyadh. I think this is telling because, of course, we're talking about this from a trade relationship perspective, from a kind of ceasefire in Ukraine perspective as well. Let's talk about this from a rates perspective and simply this idea that 24 hours ago, we're talking about the Federal Reserve stuck between a rock and a hard place. Europe had way more flexibility. Have the last 24 hours changed that?
There's a number of different ways of looking at this. You could say that you're taking the inflation risk out, so the Fed finds it easier, therefore, to focus on any economic slowing that we're going to see, and therefore can cut rates more easily. Or you could argue that the US economy is actually going to do better out of this, so that actually the Fed doesn't need to cut rates as much as we were talking about. As the Fed's got lots of very complicated permutations to think about.
And so it goes on. And talking of the inflation outlook, we will get that data from the United States a little bit later on today. We're also going to be watching President Trump, of course, in Saudi Arabia. We've got the German ZEW data coming in, what is that, an hour's time. So we'll have some data points to focus on as we watch for the new catalysts in this market. That's it for the opening trade. The Pulse is up next.